So I will definitely recommend the IIM Bangalore campus. I gained 20 kilos when I was there. So definitely it's a good choice to be there. So I think all of us, I'm here to talk a bit about markets, but I think all of us, one thing we'll agree with is that we are all believers in the India growth story, right? Yes? Yes. So the question then becomes always, why then are the markets not performing? And the reason why we'll say that it's not performing as we have expected is that markets don't look at growth. Markets look at expectations of growth. That is the more important bit. And when the expectations of growth are not playing out the way you want them to, that is when the markets stop performing. So that has been the main reason why we have seen a bit of a muted market in the last 18 months or so. The question now, what are we expecting for the future? And what are we looking at to change in the next few years? So India's growth story has been as resilient as ever. But we have had some interesting times on the global side, right? So I always, when somebody asks me about what about geopolitics, I have to remind everyone that, it's been only 1 year of Trump. And we have 3 more years of Trump to go. So multiply what you felt in the last 1 year into 3. And we have to still go through all that. So this is something we have got to make our peace with, that this is going to be something which will change, right? So the reason why I put it like this is literally the slide keeps changing like this, right? You think it is one tariff, tomorrow you'll find it's a new tariff. Day after tomorrow you may end up having to change this to a different tariff. So, another question which I get on this is that did we do the right thing by, negotiating like this on the tariffs? And my point is that, other countries tried to be very good, like, South Korea, for example, tried to be very good. And, then slightest deviation here and there, and then they are punished with even higher tariffs, or they are threatened with higher tariffs. So we need to just accept that this is something which is there. But I will, and the direct impact all said and done, this has caused a lot of noise, it's caused uncertainty. FIIs have used this as a reason to not stay in the country. But I will actually thank Trump for all the noise that he's created in the last year. And why am I thanking him? It is because actually in this entire period, we have realized that, there's more to life, there's more to the world than just US. US is definitely our largest export market. Only 12% of GDP is exports anyway. But beyond, and US is about 17-18% of our exports, at least goods export, not services. But what we have realized is that there is an 83% out there. There is 17% goes to US, 83% is to the rest of the world. It is time to make more friends with the rest of the world. So which is why we have seen a big change in terms of the agreements which we are signing. So the European Union, interestingly, I didn't realize this till it was actually signed, that the European Union does more trading with the world than US even. So European Union accounts for 28% of the traded goods in the world, while US is about 17-18%. So European Union is a more important trading partner in a sense, and we have been talking to them for 19-20 years. From 2007, India and European Union have been having a running joke called that we are going to settle the European Union trade negotiations this year. But for 20 years, we have kept on saying no, next year. But finally, thanks to Trump, we have said that wait, we need to also start talking to each other because we can't talk to US anyway. So it is a bit of a blessing in disguise that now there's an urgency which is now being seen for the whole world. So India is talking to it's talking to UK, European Union, Australia, Canada, UAE, Middle East. So a lot of new trading lines are opening up in this entire period. So that is something which is very good. It is excellent for our exporters. Some of our exporters have been struggling to compete with our neighboring countries like Bangladesh, Vietnam, simply because of this. We have had a 12% disadvantage on the free trade agreement, on the import tariffs. and that has meant that we have not been able to always compete. So this is something which is good which has happened, but Indian markets really are mostly domestically generated only, so 80% is our own story. And so we are on the export dependent side, we have low export dependence. More importantly, services are not really impacted by all the tariff trade war which is happening. So we continue to be well placed on the services side. And on services, of course, now we will talk on artificial intelligence. There's a lot to talk about that, and that is one concern area for the entire Indian market as well. But right now what I'm saying is that the bigger driver in the last 5 years has not been IT services. It has been the global capability services. So global capability centers are being set up at an accelerated pace in Bangalore, Hyderabad, Chennai, Pune, where basically the world is coming to work out of India. One positive lining which happened after COVID is that everybody realized that you can do work from anywhere. And then they said, why not then come to India, where you have a lot more things than just IT which you can do. So Mercedes, their second largest center outside Germany, is in India. Samsung, similarly, the second largest design center out of Korea is in India. You have many other companies, from oil and gas companies doing service contracts out of India, to legal and accounting, to sales analytics for some of the largest clothing and garment manufacturers in the world. They're doing sales analytics based out of India now, rather than just IT. So there's a new wave which has come, and these services are not impacted by tariffs anymore. So the amount of services, about $400 billion per year, and it's doubled over the last 5 years. So growing very, very fast, and it's not impacted by tariffs. This is our own story. At the same time, I think India growth story has had a bit of a path in the last 18 months. I think one thing which is missed very often is in 2024, we had a bit of a slowdown which was created by RBI also. RBI asked the credit growth to be slowed down. The loans and advances, it basically said that it's growing too fast. Everybody is taking too much personal loans. It's getting very dangerous. We need to slow this down right now. So that was the start of a bit of a slowdown in the loan growth. And so it is growing at about 17-18% in the month of June 2024. If you come to May 2025, that 17-18% had slowed down to 8-9%. So it has halved that amount of growth. From there, things are changing. What we have seen is that the monetary policy, which is the RBI, so RBI has now come out saying that this has to change. First, let's cut interest rates. So they've cut rates from 6.5% to 5.25%. Then they have said, let's increase liquidity. So they've cut their CRR. Next, they have said, okay, banks, forget what I said in 2024. I remember I asked you to reduce the personal loan growth and all that. Forget that. In fact, now you tell me what else I can do to increase the loan growth. So there is a very different stance which the RBI is now taking. Of course, things have changed in personnel also. So there's a new RBI governor, there are new members of Monetary Policy Committee who have all come at the start of last year. So from there to here, there's a very, very, very big and aggressive change which RBI has made in their policy. It has been a very, very long time that the RBI has been so positive in pushing forward growth. And of course, apart from that, fiscal policy also, there's a lot of support on the fiscal policy side. So we are seeing that there is been indirect tax cuts, GST for the first time being reformed, or slabs being cut, rates being cut, and we are seeing direct tax cuts also at the same time. So together, fiscal policy and monetary policy support is all together, which is going to mean that India will continue to remain the fastest growing large economy in the world. It will become the third largest, which is why when you have AI summits like this, everybody wants to come to India and speak, because everybody understands that we are still a very large economy. Even in AI, many people are most of the AI manufacturers or model makers are saying that AI has the second largest number of users in the world. We have the second largest number of open projects in artificial intelligence in the world. So India is definitely continuing to be very relevant on this side, and we continue to be positively placed on many of these fronts, on the growth front in particular. So if growth is looking good, like it's going to, if everything's looking so good, then why are the FIIs not coming? Why are they still selling? Why are they staying away? I think that is one question which we definitely need to answer. And if the Indian stock markets are going to move up, foreigners have to start buying more aggressively. And that'll be one of the things which will help the market move up. One simple reason why Indian markets or FIs are not doing or not staying in India right now is there is so much happening everywhere else. I think that is there's a huge party, a full equity rally which is happening everywhere else in the world. So if you try to find India in this list and start it from the top, then you would have to spend a long time because we are right down here. So that is the pace at which there have been a lot of stock market rally across the world. And a lot of this is because of artificial intelligence, definitely. So Korea and Taiwan are markets where artificial intelligence has been very, very popular. And they are companies which are playing a part in artificial intelligence. Second is there's a lot of war in the world also. So in India, defense is a major theme. But globally as well, defense is a major theme. So in Europe, they are committing to double their defense spending. In 2024, defense spending in the world was growing at the fastest pace since the last 25 years. So everyone in the world is really spending more and more on defense. And that has helped some of the Germany, for example, their stock markets, European stock markets at large. Apart from that, third one which is helping the world is the diversification of the supply chains. So continuing, everybody's realized that, as I said, at the start, everybody needs to talk to everybody. So as a manufacturer, if you're a company, if you're a country, you're saying that I can't depend only on China. After China, what they've done with the rare earth minerals, I don't know whether everybody's aware that the way they have used it is basically to say that if you don't do what we want, then we will not supply you with these critical minerals which are needed for many things, like your phones or even your cars. So they have held the entire world to a bit of ransom. So the importance of trying to diversify has meant that many other economies have also benefited from this. And India, I think we are well placed to start picking up on that. In the Indian markets, we are well placed on the financial side. Finance has done well. Financial services have done very well last year. And we continue to expect it to do well. Credit growth. So I left it by saying that last year credit growth had slowed down to 8 to 9% in June 2025. Today, we are sitting at 14-15% growth. So credit growth or loan growth from the banks has grown from 8 to 9% to 14-15% in the matter of 6 to 7 months. And that means that things are picking up on the banking side. At the same time, we have the asset quality, or the basically bad loans are not that high. It is at a very, very controlled levels. Margins for the banks looking very good next year after a weak year this year. So together, banks are looking good. Apart from that, we think that consumption also, so auto sales have recovered very, very sharply, and we are looking at that also being a big source of boost for the markets next year. So apart from autos, we expect there to be more consumption also playing out in a big way. So those are sectors which have done well. On the sectors which have not done well, realty and IT sector. Real estate, we think, is contrarian good bet. We think it's well placed to pick up on the rally it had in the previous years, but last year was a bit weaker. IT is something which is struggling with AI-related news. Now, our belief is that IT companies continue to be relevant in the artificial intelligence world. We think that while artificial intelligence will have some kind of an impact in terms of how IT companies are working. Companies, the end companies or clients still need IT companies. So if you're a bank and you want to implement artificial intelligence, it is hard to just go and implement it directly because it is a very, very sophisticated, very difficult project to take up. So you will bring in an IT services company which in the end will be able to do that work for you. Many companies will have to change the way they are operating only because of artificial intelligence. And for that they need partners. And partners again, IT services company. In the past we have seen this play out where, when cloud was a big move which happened in the last 10 years. 10 years ago when the shift started, many people again said that, well, IT companies are just maintaining infrastructure, IT infrastructure. So if everything is shifting to the cloud, if you have nothing on the premises, then what is the IT company going to do? But we have seen that the work only expanded. As the migration to the cloud happened, we saw that the workflow, the way things are organized in the company changes. And managing and helping them manage that transition are IT companies. So AI is going to be a similar revolution which will happen for companies, the economy, the way everybody works. Everybody here also, I'm sure, I hope is using some AI in some form or the other because it is going to become essential to use it. But it is another change, but the IT companies we think will still be relevant at the end of it. Coming to the union budget and briefly touching upon what kind of impact the union budget had. What I like about this union budget is that there's not too much to talk about. That has been the state of what's happened to the union budgets in recent times, that more is happening outside the budget than in the budget. And that is a healthy thing for an economy. As countries evolve, budgets become more stable, taxes become more stable, and you don't need to make every year little tinkering, things to change. You have more stability, and so there's less to talk about. And I think this was one of those budgets. Growth assumptions were good, but I think what was very good was seeing the government maintaining discipline in the spending. And that means that the borrowing is under control in many ways. Just looking at some of the sectors also, really, there's just one sector which got impacted negatively really in the budget, which was the exchanges and brokers. This is the hike in the securities transaction tax, which people fear will start impacting the volumes which are traded on these exchanges. So futures and options, the tax on that has increased. And so it's becoming a bit more costly to trade in some of these futures and options. So there's a bit of a worry on that day only that this could lead to a bit of a slowdown in those volumes. But apart from that, I think broadly the budget was a solid one in terms of looking at supporting services and manufacturing. So in the Indian economy today, if we speak about where is the investments happening, so I think this is one thing which we keep on asking, why is private companies not investing, why are they not investing? One reason they are not investing is because of the uncertainty which is there in the world. But at the same time, if you look carefully at certain sectors, investments are still continuing to happen. Firstly, investments are continuing to happen on the data center side. So data center is a massive investment opportunity, and we are seeing the growth in this in a big way. So in the next 3 years, our capacity is going to grow from 1 to 9 gigawatts. It's 9 times expansion in the data center capacity in India. And this is before the government supported with a tax holiday. So this is one area where people are investing heavily. Second is electronic manufacturing, where again the government has supported with a new scheme, electronic manufacturing, component manufacturing scheme. And third place where we are seeing investments continuing to happen is on the solar energy side, where again the government has supported with a solar energy scheme as well. So together we are seeing investments in these 3 places, and at the same time government has said, well, okay, you are investing here, let me support you with that. So that is the way they are looking at supporting places where infrastructure investments are happening. One of the parts which have not had any investments really, all of these are related to consumption, and consumption, well, it's been taken care of. The indirect tax cuts, GST tax cuts have already played out. So to summarize, I think this is what we are looking at right now for the equity markets. We are looking at a year where earnings are recovering, where the economy is recovering, where we're seeing nominal inflation, economy, or the GDP growth before inflation, that is starting to become more normalized. So nominal GDP is moving back to the double-digit level. That is what we are looking at in the coming months. Along with this, earnings have been continuously getting cut because the growth, as I said, there was an impact on growth, but that again is turning around. Earnings growth is starting to play out in a much better way. We are looking at many opportunities in this particular space. We have spoken about financials and consumption, but broadly speaking, we are more positive on the overall economic markets, on the Indian equity markets and the economic recovery in the Indian economy as well. So briefly about Franklin Templeton, we are a $1.7 trillion fund house, $1.7 trillion globally. That is more than double the entire Indian mutual fund industry. That's the size of Franklin Templeton globally, about 10,000 people across the world in 36 countries. We have been around, we started the company, the global company started in 1947 when we got our independence. So it's been around from that point of time. We have been here for, this says 29 years, but we completed 30 years yesterday in India. So a milestone which you have achieved. Thank you. So major milestone for us here. It's been an honor being here and serving all the investors and supporters of Franklin Templeton in this journey. During this journey, we have had many pioneering concepts. So SIPs, everybody knows about SIPs now, but we were the ones who first introduced this concept itself. SIPs, STPs, even goal-based and family solutions, a lot of these, even daily NAVs. These are, nowadays we see the NAV of our funds every day, but at one time it used to be only on a monthly basis and a weekly basis. So we started the concept of daily NAVs and publishing monthly portfolios. Now all these things are very standard, but at a time when the mutual fund industry was starting, Franklin Templeton introduced many of these concepts. True to this, we have seen some of our funds also completing 30 years. 27 funds have completed 10 years. So we have a long history of managing funds in India. We have seen that, and we have got a lot of funds which have had a long history in India as well. And over these 30 years, we have seen some of these funds generate tremendous amount of wealth for our investors, 249 times growth over the last 32 years for investors who have been in this fund. And briefly on our philosophy as well, we are long-term investors here. We believe that every stock can be valued, should be valued. It has a fair value which it represents. But first and foremost, we believe in investing in growth. So India, circling back to what you said in the first, India is a growth story. We believe in the Indian growth story and we invest into that. We believe though that every stock which represents the Indian story has a fair value. We believe that we can assess the fair value and invest accordingly. We also believe in the fact that unless companies have good managements who are thinking about their investors all the time, we will not be able to generate good, positive, long-term returns. And that is the basis of our investment philosophy. Okay. Should we stop? Huh? Yeah, we can see for that. Okay, fine. Just a few of our strategies as well, just running upon our few strategies. One of them is our Franklin Build India Fund. Now, this falls under the infrastructure category theoretically, but we believe that this really represents the growth of India. And it means not just infrastructure, but it's a broad theme, investing into transportation, power, utilities, industrials, materials, telecom, etc. So this is a fund, while it looks like it's an infrastructure fund, is actually investing more broadly. It's investing across market cap and finding opportunities. Anything that you can say is going towards building India, that's where you can find the Build India investing. So it's always invested across market caps, large, mid, and small cap. It has always had that approach. We have the investment process which has been continuously followed, and the Franklin India Build India Fund has adequate diversification. It is not a narrow fund which is only investing into infrastructure, but is looking across themes to be able to find ideas where India is growing. It is more oriented towards industrials, manufacturing, towards whatever is growing India, not just consumption. So consumption will be lower here, but investment will be higher here. So I think that is the proxy which we can think about. Another interesting fund is our Asian Equity Fund. Now, why are we talking about Asian Equity Fund? While I've spoken so much about India, having global diversification is something which is also always healthy. Not winners always rotate. So in your portfolio, having something which is winning all the time will keep your portfolio always steadily moving up. That is a more steady way to grow your portfolios itself. And the Asian Equity Fund invests across Asia ex-Japan. It has about 35% in India, but 65% in China, Taiwan, Korea, Singapore. So not just India, but beyond India. Asia is a key driver of the global economy now. 80% of emerging markets is now India. It has among the youngest populations, and it's among the most innovative parts of the world. So as part of a global diversification, the Asian Equity Fund is something which we can look at as well. The interesting thing about this is Franklin Templeton, we manage this directly. It is our own portfolio of stocks, but we have teams on the ground. We have a team in China, we have teams in Korea, Taiwan, Singapore, where we get the insights of what is happening on the ground and make the portfolio accordingly. So this is a breakup exactly of how the fund is right now. So this is the overall Asian economy, while this is a portfolio which we have got right now as well. Some of the largest companies in the world, like TSMC is Taiwan Semiconductor. It's the largest semiconductor manufacturer in the world, more than 50% market share globally. Any chips which are manufactured in the world, TSMC possibly has a role in that. And this is the performance over a period of time. Finally, just rounding off again on the Franklin Templeton, what we have been doing all these years. We have had, the Franklin Templeton advantage brings, we've got the academy, which we encourage you to reach out and have a look at some of the content which is there. There we continuously bring out global thought leadership content. We continuously organize PM interactions, so frankly speaking, and we look forward to always interact with our partners, clients, investors. We love speaking and getting feedback from them and understanding how they are thinking about it as well. At the same time, we have some of these investor awareness programs which are continuously conducting. And Blinkist is one of the, it's a summary for if you want to read books, if you like reading books. This is an offering which we have for our partners, where you can get a summary of the best books of which are there right now. So at this time I will pause. I'm happy to hear and interact with some of you as well. Thank you very much for your time.
Thank you. Thanks. I have got a couple of questions, if it is okay with you, actually. See, basically you are talking about ITs and how it has been associated with at this point in time, and you have used as well. But are you accumulating ITs at this point in time? With the valuations around the corner.
So we already have exposures to IT, and it is The stocks are getting, I can't speak exactly about what actions we
No,
might
you
be
don't have
taking.
to mention the stocks,
Sure.
but I'm saying, is it in an accumulation zone at this point in time?
We think so. So if you've got a bit of patience and you've got an approach where you can take advantage of volatility, then it is a time when you can think about accumulating into IT. See, the point is this, that this is not something which is going to resolve itself very quickly. So we have the time to accumulate into this phenomenon which is happening. See, this year, if you look at how much Google is investing, they have said that they're going to double their investment from $65 billion to $180 billion of investment in this year. That is a huge amount of money, and that means that this year, artificial intelligence will continue to see investments being made. We'll see new models coming out. The capabilities are only improving. So there's going to be a lot of noise, hype around artificial intelligence, which means that these stocks will continue to have these bouts of nervousness around them. But at the same time, they're attractive at 5% free cash flow yield. Their PE ratios are down to 5 years ago. So basically, some of these earnings have gone up by 50%, and the stocks are still there. So they become much cheaper in this period of time. And for the patient investor, lower valuation is your friend.
Can you define the patience?
No, that's always a bit hard, but I'll point out two catalysts which will help you get a sense of whether, when the tide is turning. One will be when we see a bit of hype. This is a bubble kind of mania which is building up. At some point of time, a tipping point will be reached where people will get nervous about the amount of investments which are being made. So far, it has been that they have been investing out of their own pockets, but now they're starting to take debt. So you've seen some of the large companies actually going to the bond markets and raising debt money. When debt starts building up, that's when nervousness happens. At some point of time, there will be that nervousness will tip over. And at that point of time, India becomes an anti-AI, and IT becomes the perfect anti-AI play at that point of time. So nervousness. Second point is that when there is more conviction that the earnings are not being hit at all. So at that point of time, you will start, when these two combine, that's when the turnaround will start picking up in more acceleration.
Just one more question. I'm sure many of us would have this question as well. See, there are lots of negative news that's floating around the market at this point in time. Can you just sum up three main positives to talk about at this juncture?
So, three things which I will point out to. Firstly is that earnings are coming back. Next 2 years, 15% growth rate we are talking about in terms of the earnings. To give an idea, last year Nifty grew by 8%, or this year rather, FY26 is growing at 8%, last year it was 5%. From there we are seeing acceleration to 15%. At the same time, relatively, compared to the other markets in the world, India has become much cheaper. So valuations have become much better than they were. And together we are seeing that this growth, there's a lot more confidence in the earnings growth also. So normally earnings have been getting cut very, very sharply. This time we are saying that earnings are not getting cut at all, or in fact they've been upgraded. Most recent earnings, we've seen the earnings getting upgraded. So that there's this big change in the economy and the economic momentum also. I've spoken about a number of parameters, auto sales, CV sales, credit growth, a lot of things have, there's a bit more momentum coming in the economy as well. So these are 3 points which I say: economic momentum, earnings momentum, and valuations relatively looking better than it was.
Economic momentum, valuation, and the market's looking much better at this point in time in terms of valuation. Thank you. Thanks a lot for such a detailed insight. Let me invite Mr. Varadarajan to hand over a memento for Mr. Hari.
Thank you.